It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group.
This is Managing Your Financial Future. Welcome once again to the podcast. It's a wonderful day here. It's actually a spring day here in, we're in Southern California. I'm here with Professor Rick Plum. It's kind of a nice day out today, Professor. This is one of my favorite times of year.
It's San Diego. It's a nice day.
It's a nice day no matter what. But these are the really good times. I think between May and June, not too hot. It's just kind of nice.
But for people that want to travel to San Diego, May and June are not very good months to come out here.
Well,
we get this weird weather thing called May gray and June gloom, and it's just not the best thing.
The famous marine layer has taken over. Anyway, we're happy here.
Not the U.S. Marines.
No. That's people get a laugh out of that when they hear the marine layer. They don't quite know what that means. It's just the cloud covering. But anyway, we are not outside. Maybe we need to start doing podcasts out. Maybe we should do one or two outside.
We did a show years ago. I don't know if you did it with us. We did a remote broadcast of our daily radio show from the Miramar Air Show.
No, we did. I wasn't part of that. I was not part of that. But
what a dumb place. We were right on the flight line.
You know why? Because we were at a radio station that sponsored it.
Yeah, big time sponsor.
That sponsored the Miramar Air Show, the Top Gun. I mean,
that was back when Top Gun was there.
This was Top Gun, and our radio station. I didn't do our show. I was doing other shows at the time, and yes, you had to be quiet for.
Well, you didn't have to be quiet. It's just nobody could hear you when the jets were taking off.
But it was fun.
Oh, it was awesome.
But it was also August, as I recall, and it was about 109 degrees on the tarmac. So anyway, we'll have to think about that. In the meantime, we got stuff to talk about. You last week, Professor, you are the advisor here. I am just the host. I'm Johnny Dean, by the way. You are Professor Rick Plum, certified financial planner, professional, all that. We did a topic last week, and it had to do with annuities. We explained kind of what's
some of the different
things
types
you need to know about annuities. Now, annuities, Professor, come in so many different shapes and sizes these days.
Yeah, there is no one thing other than they're issued by insurance companies and they're tax deferred. Other than that, there are lots of different types of annuities. There are different moving parts. There's different terminology. It can be it's a study in itself more than just a podcast.
It is, and the complexity of the different types of annuity products that are offered has really kind of given, in certain instances, annuities a bad name because amid the confusion, I think there are certain salespeople out there who use that confusion to
either pro or con. There's some that use the complexity
to sell somebody,
and somebody who use it to sell against it.
Yeah,
it's not that they're right for everybody. Nothing is. But sometimes, the way they're designed, they work for certain specific instances, and they don't work for others.
And that's why we talked about it last week, because it's important to understand what it is you're buying, or at least understand what you have been offered, perhaps, by an advisor or whoever. Maybe you read about it online. Are these things good? So we did this last week, and we did some explanations of certain types of annuities in a general sense. We had an email here. We actually got some very positive response out of that because it's helpful to know what you're getting. But this came from, I don't have the name, but that's okay. I don't need a name. This is a comment they said based on the last podcast I listened to. And it's directed at Rick Plum.
Bring it on.
Oh, man, that sounds ominous. The subject of the podcast was guaranteed income, and my comment is about annuities. This person says, I realize there are literally hundreds of annuity variations, and it would be impossible to cover all of them on the air, but there was one type of annuity that my wife owns with a feature I felt was worth mentioning. When she retired in 2017 from teaching in Washington State, we took all of her 403B money, plus the income she had deferred, plus her small pension, and we purchased annuities through a program offered by the state. Have you heard of they have different state programs?
I'm not sure which program they bought through. It may be that they bought it through the 403B, the people that offered the 403B in the first place, which is typically an insurance company, or in many cases an insurance company.
Well, if she was a teacher, then she worked for the state. So, okay. In this case, she purchased a single life annuity that pays out 7%. Okay. This provides us with a predictable, steady stream of monthly income. This person says, in your podcast, you implied that when you purchase certain types of annuities, you're betting that you are not going to die anytime soon, because if you did, the money is gone, or at least that's how it sounded to me, according to this emailer. And it may be the case with certain annuities. Now, we didn't say that was true with all of them, but there's
when we're talking about an immediate annuity where you basically trade in cash value for a stream of payments, and there is no cash value left, that stream of payments is going to be based on some selected option, and we basically talked about the life only option.
Right. Now, the emailer says, however, and I went back to check the contracts, with the annuities my wife purchased, if she dies before the annuities pay out what she put in, the difference between what she put in, the purchase price, and what they've paid out so far is paid out to her designated beneficiary. So if this were to happen, it would have been like getting back her own money over the course of her life. While this is not the ideal outcome, I felt it was an important feature of these annuities, and I suspect is a feature in certain annuities that would be attractive and important for listeners to know about. It says, I enjoy listening to your podcast. The one you did during tax season was especially helpful and was information I think you should repeat on a yearly basis. Well, thank you for that. We appreciate that.
We've heard that about the tax information podcast multiple times, and we're planning on doing it a little bit earlier in the tax season, maybe that next year.
I think we will. Maybe first thing. We'll have to see. First thing in the new year. But
yes, there are different ways to take a payout. We're just talking about immediate annuities, and there are multiple different types of payout options. You can get them for a specific period of time. 5 years, 10 years, 20 years. And, it has nothing to do with how long the underlying, the person who bought it lives. The payments will continue for that number of years. It's called a term certain payout. Now, what they chose was a refund option. They took he said life option, so it will continue to pay out for as long as his wife is alive. And so this is where I said it will be a much better deal if you live a long time. Now, if she unfortunately passes away too early, the family, somebody, will be able to get back at least what was left of what she put into it.
So if they put $100,000, just to pick a number,
right, and so it's paying out a payout of 7%, which in today's world is not too bad. That's not a 7% earnings rate. That's just if I put in $100,000, it's paying me $7,000 a year. That means it's going to take 14.2 years to get my $100,000 back. So if she passes away in the first 14.2 years, somebody will continue to receive that $7,000 a year for the balance of that 14.2 years. So you don't, they're going to get their $100,000 back at some point, but they're not going to get any earnings at that point. So that's called a life with cash refund, installment refund. There's different ways to do it. If you wanted to get a lump sum refund, you could do life with cash out, or lump sum refund. Where if it's paid me $70,000, I live 10 years and it's given me $70,000. There's still $30,000 that hasn't been paid out from what my original investment was. I die and my heirs get $30,000 in cash. Or the installment method, they get the continuing payment of what I have. And you can start doubling up these types. So you can do a life only with a term certain. So it pays for your lifetime, or the term certain, whichever is longer. So there's lots of ways to do it. Now, anytime the insurance company is on the hook to pay out for a longer potential period of time than what otherwise might have happened, you get a little bit lower payout.
Sure, of course.
So maybe I would have gotten $7,200 or $7,300 a year if I took a life only option, but because I took the life with installment refund, I only got $7,000 a year. Mm-hmm. So but that way, if I die too soon, somebody gets the rest of my $100,000 back. Well, so it all depends on what you're trying to accomplish. If it's just a matter of if you want the highest payout for your lifetime, and you want it based on your lifetime, and you're not worried about what happens after you die, life only will give you the highest option. But as the emailer mentioned, I did say that if you die too soon, with a life only option, it's your life only. There is no payment after that. If you only make it 1 month, the insurance company wins on that one, and we don't like the insurance companies to win in that particular issue.
Well, and the same
but you
thing,
can, and you have to select it at the start of the contract.
Well, this is true. This is much like pension options as well, because you are with an annuity, you're really purchasing a pension.
And pension options have similar, say you can have a joint and survivor option. With a pension, you're and this is a big question when you're getting ready to retire and you have a pension, and you're married. You're going to have options. Mm-hmm. Now, typically, your pension, when you get an estimate or when they're talking about it through your working years, they're telling you that you're going to earn X amount as a pension. And they're usually talking about the single life payment. So if you're doing your planning, and they tell you, if you work here, a teacher in California, you work for 30 years, you retire at 60 years, or you get 2.4 or 2.6% times years of service, times basically your salary. So you can do the calculation, but that is just your life only. What if
the highest payout?
That's the highest payout. But what if you need to provide something for a surviving spouse? If you're the older of the two, maybe the least healthy of the two, and you haven't saved a lot of other money because you've known you had this great pension. Why? I've seen teachers that can actually deal with it for 30 plus years. They get very close to their annual income for the rest of their life.
Absolutely. I'm related to one, so it's helpful.
Yeah. And so a lot of times they don't save a lot because they don't have a lot of extra money to save as well. So they've got these great pensions, but what happens if you're married and you haven't saved a lot, you don't have a lot of fallback, and this pension needs to continue regardless of who's alive? Well, then you have to make an option. You have to take an option, joint and survivor. Do you provide 100% of what your pension is? Now, it won't be 100% of what they're talking about. But the 100% of what you would receive while you're alive goes to your spouse.
In other words, the checks you've been used to getting will continue.
Right. So you've earned a pension of $5,000, but if I want to leave something for my spouse, I'm going to have to take a lesser amount. Now, why would that be? Well, because the insurance company may have to pay longer.
They will have to pay longer unless you both go together.
Yeah, the odds of you dying in the next X number of years is a certain amount of odds.
Yeah.
The odds of two people dying within the next 2 years is a longer odds. So the insurance company or the pension knows they're going to pay it out longer. So you can say, well, I'm going to provide at least 50% of my pension to my spouse. That takes a little bit of a haircut from my life only. I need 2/3 going to my spouse. I need 100% going to my spouse. Each one of those, the more that you provide for a surviving spouse or other beneficiary, the less you're going to get. And how much? It depends on how young that person is that you're adding to that potential life payment. If you're 60 and your spouse is 50, the haircut's going to be quite a bit more than if you're 60 and your spouse is 70.
So when you choose these options, whether it's a pension or an annuity, they're looking at the age of your...
They're looking at what they're going to probably have to pay out.
So if I have if I'm 60 and my spouse is 50 and I decide, well, I want to continue this, I'm going to have to take a greater haircut on my pension payments if I want to continue for my 50-year-old wife, as opposed to if my wife were 60 or 70.
Right, because
they look at that.
Well, yeah, because they figure that 50, it's a high likelihood that they'll continue paying that payment. A 60-year-old has a life expectancy of 22 years, give or take. I don't know what the number is nowadays. So they expect on life only, they're going to pay it out over 22 years. But if they're doing a survivor option and the survivor is 50, that's more like a 33 or 34 year. So the insurance company or whoever's backing this, doing the actuarial numbers, are saying, we've got to make this last for 30 plus years. That means that's a lower payment.
Yeah.
And so that's what it's all about.
So if you look, and I've looked at our pensions, and the same thing, we're talking about annuities, of course, but
it all comes together because a lot of people call their pensions an annuity.
Because it's an annuitized.
Well, the classical definition of an annuity is a stream of payments. What other stream of payment is there? I mean, the most popular form of stream of payment is a pension.
Absolutely. And since they don't have pensions all that much anymore outside of certain jobs, then it's
municipalities and teachers.
You may want to purchase one.
It's right. Funny. And so they all kind of work the same way, other than, the dollars may be a little different.
I never hear anybody criticizing companies for offering pensions and anybody being criticized for taking a pension that they're entitled to. Yet I hear people criticizing those who sell annuities and say you should never, ever own one, which is just a form of pensionized income. I don't really understand.
Well, you don't necessarily see the cost involved in the pension. You just know that you've worked there for X number of years, and they've told you that you get a pension of Y amount of money per month. But they don't. There's no correlation to. You mean that pension's worth $300,000 today to get that? $2,000 a month or whatever the number is.
We're making the numbers up.
Purely, but it's a matter of you're not buying it. It's not like somebody's selling it to you. You were offered it. You never saw the money going into it. You never saw it come out of your paycheck. You didn't know how much of your overall pay
is being
went into
deferred to that. Yeah.
And that's another thing. When somebody's making $50,000 a year, but they've got health insurance benefits, they got all that, and the company's paying for a lot. Their true cost to the employer maybe $80,000 with everything that the employer is paying.
Absolutely.
Now,
and that could include a pension.
I'm hoping it does with that kind of a difference.
I would hope so too.
Unless, unfortunately, you're one of those situations where you're a roofer or something where your workman's comp insurance premiums are just through the roof.
Through the roof. That's
I was trying to. Once I got on that jag, I was like, I can't say that.
How ironic! You fall through the roof, and your insurance, premiums are through the roof. So we're talking here about I know, as I said, we talked about it last week, and we brought it up. We explained these. This emailer brought up a different type, and yes, it's important to understand that not all annuities, not all of them are. You give the insurance company your money and it's gone.
No, and we're talking about in this particular area. We're only talking about what they call immediate annuities, and they're not the only type of annuity that creates a payout. Over your lifetime.
We talked about that last week. There are those that deferred.
There's also a deferred annuity that has a rider that creates an income stream that looks a lot like an immediate annuity, except for whatever the cash. I give the insurance company $100,000. They're probably not going to give me $7,000, but they may give me $5,000 a year. But I still see the cash value.
Yeah.
And maybe the cash value is invested in a variable sub accounts like mutual funds, or maybe it's invested in index accounts that pay interest. So the cash value has some potential movement on the positive side, in addition to me drawing cash out of it. And the promise from the insurance company is that if the cash value ever goes to zero on that type of contract, they're called lifetime income annuities, that the insurance company will continue to pay out that lifetime income.
They have to.
And you'll notice there, too, that if I'm covering just me, I might get maybe 5.5% when I'm 65. But if I'm covering me and my spouse, maybe it's only 5%, or it's a different percentage payout for many of them.
So we've seen interest rates change. We've seen interest rates rise over the last year, whatever it's been. Has this had any effect at all on annuities? I want to get into this just a little bit.
Well, annuities are with the exception of variable annuities. Variable annuities have investment sub-accounts, which are very similar in my mind to mutual funds. So you can look at them similar to mutual funds, but they're slightly different. But those are totally dependent upon the investments that you choose. But other annuities, immediate annuities, fixed annuities, fixed index annuities, even structured capital index annuities, they all have a component that is based on what is the current interest rate. It has to do with what does the insurance company believe they can earn. How are they structuring the payouts behind the scenes? And with the higher interest rates and with the higher volatility, when it comes to different types of annuities, those two components allows insurance companies to offer what I would call more competitive rates. For a period of time, we had very low interest rates, and realistically, volatility was a little bit on the tame side. We were still seeing. I mean, there's one given in the world today. Okay, there's three. There's taxes, there's death, and there's volatility in the market. Okay, right. Those are things that are going to happen, but. It was somewhat a little bit more tame, more on the positive side. We didn't see it so much. And so insurance companies didn't have that volatility. So the index and structured capital annuities didn't have the juice in the way they price them to be able to offer very strong earnings rates. Interest rates. When interest rates are, at point nothing, insurance companies, they're investing in bonds and other things. They're not earning very much on their general accounts, or not as much. And so they can't pass
it on to you.
They can't earn as much. So now that interest rates have come back up a little bit, insurance company and the volatility has come back up, we're seeing interest rates on these types of, interest-sensitive, volatility-sensitive annuity contracts start to look somewhat attractive again. We were not seeing very attractive contracts in the last, 3, 4, 5 years.
When you say attractive contracts,
well, I mean, if my interest rate, the best I can do is like 2%. Over, and you have to lock in for 5 or 6 years to get it. It's just not that exciting.
So if you give money to an insurance company, see, this is where people get confused, I think, because you're talking about what is an investment, a rate of return, yet annuities tend to be, well, I just want to get a stream of payments.
There's the immediate annuity that is a stream of payments. And that immediate annuity is going to be based on what the insurance company thinks they can earn. And if the insurance company doesn't think they can earn a lot in interest on their bond portfolios and other things, then they can't pass that through to the contract holder. Yeah. So when interest rates are very low, and for a while we were looking at immediate annuities, and it was like they should outlaw 10-year or less annuities, because I put in $100,000 on a 10-year term certain, which means I'm going to get 10 years worth of payments. And I wasn't even getting $10,000 a year.
What, you're getting less than?
Yeah, less than I put in, but I was guaranteed to get it. And so nobody was buying them, for one thing.
Of course not.
But that was what the insurance company was dealing with, because they have expenses. And so the insurance company can't just take that $100,000 and invest the whole thing. In some different states, you have insurance premiums, taxes. Mm-hmm. If I give the insurance company $100,000 on an immediate annuity, certain states have up to 3% in taxes right off the top, where the insurance company only has $97,000 left. So it's a matter of they've got to have enough earnings to be able to make a payout that makes sense. So now we're getting back to the point where they're starting to make some sense.
Yeah. So what you're saying is the amount of money that you give the insurance company in the form of an annuity contract, fixed annuities, fixed index, whatever it is, because they can earn a little bit more interest.
They can pay you a little bit more.
Which means that the amount that you can receive on a monthly, yearly basis
for a payout annuity, or if you're just looking at a deferred annuity and you're saying, you know what, volatility is back and I do not like it. I just not sleeping well at night watching, because even though I shouldn't be going online and looking at my portfolio, I tend to gravitate towards it and look at my statement, and I don't like what I see. And so I want to have some portion of it that I know doesn't go down in value. But CDs are paying almost nothing. Banks have not really raised their rates yet. They will soon, as interest rates show they're going to be around for a little while. And so insurance companies have raised their fixed annuity rates. And so where I used to be able to get maybe 1.6 on a 3-year fixed annuity, maybe I could get 0.8 on a 3-year CD. I can now get over 3% on a 3-year CD or 3-year fixed annuity.
These rates change all the time, by the way. But
they're going up a little bit. Yeah. I mean, every time I look at them, they've gone up, 10, 15 basis points. And a basis point is 1/100th of a percent. So 1% is 100 basis points.
So 50 basis points is half a percent. That's how that works.
It's just easier to say 15 than 0.15%.
So when people say things like cap rates, if you've ever been reading about things like about annuities, and I saw a story just this morning where it talked about the cap rates are looking attractive or they're getting higher. What does that mean?
They're talking about either a fixed indexed annuity or a structured capital index annuity. They both work off of different types of earnings strategies. And that earning strategy is going to be based on the movement of an index, hence the term fixed index annuity. So the easiest one to understand is the 1-year point-to-point, where they look at, if you put $100,000 in today, let's say your contract anniversary is today, they look at, and you're going to use the S&P index, so the S&P 500. They look at what the index is today. And then it's a 1-year point to point. So they look at this point being first point, and 1 year from today, they look at the S&P index again. Where is it at? Is it higher or lower than it was today? The earnings that you're going to receive on this particular type of strategy on a 1-year point to point is going to be, you're going to get paid interest equal to the movement of that index if it's positive. But only up to a certain point. It's going to be capped off. So where we were seeing caps in the 3.5% range a couple of years ago.
In other words, if in this
best
example,
you were going to do is 3.5.
If the S&P went gangbusters and was up 20%,
it did a couple times,
and you're only going to get 3.
Right. And so if the S&P from your measuring period, that 1 year point to point, it only did 2, you only got 2. If you did 10, you only got that cap of 3, 3.5, 4 maybe. Ugh. Now caps, 3 weeks ago I was looking, they were in the 6s. 2 weeks ago I saw one in the 7s. Last week, earlier this week, I think I saw one in the 8 range. So the caps have come quite a bit, and that's a function of the volatility in the interest rates. So the more volatility we have, the better it is for index annuities. The more interest, the rates that are higher, the better it is for fixed index annuities. And so we're getting to a point where on a year-over-year basis, if the index goes up, you get the return that the index did. Now, this is the index, not the mutual fund. This is just the index. And the index does not include dividends. It's just the straight index. But if it goes up 10%, you could get 7 to 7.5%, 8%.
What if? And the question, of course, is what if it goes down?
Now, this is where it is not an investment in the index itself. You are invested in the insurance company. They're guaranteed to pay your principal, and they're guaranteeing your principal on a fixed index annuity. And so if the index that you are using to calculate your interest rate goes down, you don't earn anything. You earn nothing. You get nothing. You go home. No, but
you don't lose.
But you're not in the index, so you're not invested in the.
So you're credited with zero interest, even if your index went down by 20%
or 30%
or whatever.
Now, what happens is so this year we start with today. We end a year from now, 2023, and then in 2023, let's say it's gone down 20%, 30%. That point, okay, it was down. I didn't earn anything this year. Now that point. The ending point of the first year is the starting point for the second year. So you're more likely going to get a good rate of return the next year.
Historically speaking.
Now, it could be like 2000 to 2002 where it was down 3 years in a row.
But you have a new starting point.
Right, for calculating your earnings rate. Now, this is where you have to be a little bit careful, though, is the insurance company, in most cases, can change that cap rate on every anniversary.
Even if you have,
and you can't get out of it because there's a surrender charge for the first X number of years. So you want to look for insurance companies that have good integrity on their renewals. There are a few that offer out there that guarantee it for each of the 1 year terms for the period of time that surrender charge is in force. But that's when you're looking at, now we're getting, a guaranteed account that 1 year, if you've got a 5-year surrender schedule, meaning you're going to be in it for 5 years because there's a substantial penalty for early withdrawal in that 5-year, 7-year time horizon. Some of them are as many as 15 years. I don't like those, but 5 years, maybe 7 right now. You're locking it away. You figure you might, we cap out. You might get your cap rate 3 or 4 of the 5 years, and you might get a 0 1 or 2 of those years. And so, you figure you're going to get, what's 24% over the 5 years or so? It's not. It's still better than. But you've got to guarantee a principal. What if you want guarantees of principal? What are your options?
Well, see, and here's where we get back to this when we're talking about things like annuities. We're talking about rates of return. We're talking about cap rates. We're talking about getting better payouts. We're talking about getting potentially more interest paid to you on your cash value, whatever it is. But you're not really buying these necessarily, I don't think.
Well, you're not buying them to set the world on fire with the rate of return you're going to get.
No, the point is you're purchasing, as I understand it, you're purchasing them for the guarantees and in some cases for the guarantees of income.
Right. You're buying them for some bell or whistle that the insurance company is offering that nothing else out there can offer.
Right.
There are no other investments that can use the G word, guarantee. And that guarantee is coming from that insurance company, so make sure you're with a good insurance company if you're looking for guarantees.
Not the, what did you call it? The shifting sands of...
Yeah, you're not playing with shifting sands of Iowa Life Insurance Company.
No, I don't know. I think if you're going with a big insurance company, well-known...
Yeah, look at their ratings. But structured capital annuities are similar to index annuities, except for they do not have the guarantee of principal. They have a buffer or some kind of waiver of risk on the first X% of downside.
But once you hit the downside,
then you experience the rest of that downside.
So if it goes down 12% and you have a buffer of 10,
you lose 2.
You lose 2. Okay. Well,
but you can get buffers in 10, 15, 20, 30% downside protection. Just know that the bigger the buffer, the less of a cap. Now, I was looking at some the other day. Caps were in the 14% range on the ones that had a 10% buffer.
Well,
first off, the S&P would need to go up 14% or more.
Yes.
And hopefully it doesn't go down on a point-to-point. And this is just one type of strategy. There's cap rates, there's participation rates, there's spread rates. When you get into these, you have to understand the strategy that you're using and understand the index. I mean, because a lot of the insurance companies have created their own indexes. So a participation rate is where if you've got a participation rate of 60%, if the market goes up 10, you get 6. You get 60% of whatever the market did. Yeah. So, or whatever that particular index did. Now, I've seen some insurance companies say, we offer 100% participation rates, no caps.
Wow.
But their index that they're using is some risk-controlled index that puts like 70 or 80% of the money in cash.
So you're not going to.
So that, to me, is like a participation rate because you're not participating in that point.
And a cap rate almost. I mean, it's...
So you just have to really pay attention to what the strategy is. And unfortunately, it can get complex.
Well, it does get complex because of all the different things that are offered to you. It's almost, I don't know how anybody would really do this without help. First of all, don't you have to know why you're even looking at this stuff?
Right. You want it to fit a specific need. And the need is not to get market-like returns with no risk. That is a misnomer, a fallacy. That's what they used to be marketed like that, though. Oh, yeah. Because you're not going to get total market returns because there's going to be some kind of limiting factor, the cap, the spread, the participation rate, whatever the case may be. They're out there and looking, and so you have to know what you're buying. But they do serve a purpose for somebody who's looking for, I don't need this money. I'm going to retire in 5 years. I want to make sure that I can draw down, 70, 80, or $10, $20, $30,000 a year, starting 5, 6, 7 years from now.
And you don't want anything to happen.
I do not want the market to go down 3 years from now and I can't afford to retire. I want to know that I can retire when I want to retire. I don't want the market to dictate it to me. So I want to put some money on the side that can still earn something, but that has no risk to principal.
Which would be, for some people who don't know, that might be a CD. But what you were saying was
CDs are paying almost nothing.
Paying as much. Now you can sort of play the interest rate game and say, well, I could probably get a little bit better potentially out of this annuity product.
And so that's where these types of contracts fit in a portfolio. They're not the long-term side of the portfolio. They're the middle. They're the 5, 6, 7 year, the fixed index annuity, what they call MYGA rates, multi-year guarantee. They're in the 3.25% for 3 years. So if I'm retiring in 3 years and I want $50,000 a year from my portfolio, I want to buy some time for the rest of my portfolio, the market-oriented issues where I want to have a few more than 3 years. So maybe I buy 6, 7 years worth of cash flow. I need, call it $30,000 a year, 6 years, $180,000. I put $180,000 into one of these contracts, and I think that I'm going to earn. Well, I know that I'm going to earn 3%. Can't earn less. It's guaranteed. And 3 years from now, I can start drawing it out, and But that gives me, 10 years for the rest of my portfolio, and so now I've got a chance of getting a reasonable market return with the rest of my cash because I've protected my time horizon with the more guaranteed side.
So it sounds like you could use these in some form of bucket strategy.
It's almost like they were tailor-made for buckets.
Doesn't it sound like that to me? I don't know why I got that idea.
We've been dealing with bucket strategy investing for decades now.
Yeah.
And years ago in the 90s, these multi-year guarantees, we used to be able to get immediate annuities that paid out over 7 years and had an internal rate of return to the client of 4+%.
Wow.
I was just talking a little bit earlier in this podcast about 10-year, fixed annuities or immediate annuities having no rates of return. Times have changed. We're not back to the 90s rates yet, but we're not at the 2015-16 rates anymore either. So luckily we're getting close to the middle. Yeah. So but it's all a matter. We've used bucket strategy investing for a long time. And at times, for the safer side, for the guaranteed investments that we needed. Remember, the guarantee is from the insurance company, not from anybody.
Not from the government.
Not from the government, not
or
from anybody
FDIC
here.
Or any of that.
Or anybody here in this office.
No.
But they can fit. Sometimes they work. Sometimes they don't.
Do you see them as a bucket 1 or bucket 2 generally? Where do you see these?
The multi-year guarantee can be for the longer side of bucket number 1. Remember, what is bucket number 1? Bucket number 1 is the cash flow that I need over the next 1 to 7 years. Well, if I'm talking about a 3-year lock period, that's not going to do for the money I need this year, next year, the following year. But it can be used for the money I need in years 4, 5, 6, 7.
So let it sit there.
Let sit there for 3 years.
That bucket.
And that I have my income cover for years 4, 5, 6, or however many years I'm looking at. Mm-hmm. The index annuities I was talking about typically have a minimum of a 5-year time horizon. And so they're not really for bucket. And we're getting out towards the end of what we call bucket number 1. So that's more for the more conservative bucket number 2 type investor, or for the really long part of bucket number 1, depending upon how long you want your bucket 1 and 2 to be set up for.
And everybody's situation is different. Of course, it's you always take into consideration somebody's risk tolerance. You're always going to take their time horizon, their goals, and all that stuff. So potentially these could be used.
Right. They're not for everybody. They're not,
just a tool.
But they are. Yeah, it's a tool.
That's as we've been saying. We've been talking about this, and I know we did talk about annuities last week. I try not to do back to back.
But somebody gave us a challenge almost.
Well, because they did bring it up, and it was a good point that what we need to do is tell you that there are more than just the few that we talked about last time. A whole bunch of different options, and it's not just with annuities; it's with pensions. So people with pensions really need to pay attention to things like this.
But all of this is part of planning. And all of this, because having pensionized income, having Social Security, pensions, and or guaranteed fixed lifetime income can make you a better, less emotional, more rational investor with the rest of your portfolio. And while they're not the great, maybe they don't have the greatest rates of return going, there is value to sleeping at night and not worrying about what the heck is going on with the market.
No, and in fact, I want to talk about that next week. I want to get into that. It's a great segue. Next week, I want to talk about the markets. Now, depending on when you're going to be listening to this podcast, the markets could be recovering or they could be tanking. Who knows? But the point is, we've seen volatility this year in 2022, and we're likely
negative
to see
volatility.
Well, negative volatility, yes. We don't talk so much about the positive volatility.
We love that volatility.
But who knows? Who knows? So I want to talk about that next week. If you need help with this stuff, if you're concerned, if you'd like to know more about the guaranteed forms of income from an insurance company or potential use of annuities, as I said last week, give the folks at Lucia Capital Group a call. They're happy to help you out. I would suggest that it's best to have a professional person look at this and tell you, here are the good parts for you, here are the bad parts, here's why I think you should possibly consider it, here's why I don't think you should consider this kind of thing at all. Give them a call, 800-644-1150. That's the number of the Lucia Capital Group, 800-644-1150. This guy right here with me, Professor Plum, is involved in all aspects of the plans, all aspect of planning. Every plan goes through you, Professor Plum. You take a look at it, you review it, and sometimes you get to talk to clients when you're not talking to me.
That's the fun part.
It is, isn't it? And sitting there figuring out how to make this thing work.
Oh, it's a wonderful puzzle to play with.
800-644-1150, or you can get in touch with them at their website, luciacap.com, luciacap.com. Subscribe to our podcast. You get all these great topics. Spotify is where you find us. Spotify, and listen, download to your heart's content, and listen whenever you want. Listening on demand, that's the key. Again, 800-644-1150, the number at Lucia Capital Group. My thanks to Professor Rick Plum, certified financial planner, professional, CFP type. For him, I am your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Fixed indexed annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Investors should speak with a financial professional about the contract's features, benefits, risks, and fees, and whether the contract is appropriate for the investor based upon his or her financial situation and objectives. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Variable annuities are long-term investment products designed for retirement purposes. Variable annuities with guarantees are available through optional riders at additional cost. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a variable annuity's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Variable annuities with guarantees are available through optional riders at additional cost. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investment products described herein. Any investments or strategies referenced herein do not take into account the investment objectives, financial situation, or particular needs of any specific person. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.